I'm not the professional you are, but it doesn't look like the markets are very happy this week, if I can put it that way.
No, I mean, boy, it was it got a dose of tightening financial conditions in an aggressive way. I mean, when Chair Powell talks about Volcker and being aggressive on inflation, and consequently the idea you're going to tighten financial conditions, that is an environment where the bond market and the equity market don't do particularly well. So you saw that play out in a pretty extraordinary way. I mean, not just where the market's soft. You know, there were a couple of things that are interesting. One, it was the bond market that was leading the equity market. The equity market was amazingly resilient until the last couple of days. And it was almost like the memo got through that, gosh, we're tightening financial conditions. Rates have moved significantly higher than the equity market turned down. But, you know, it's a market ripe with uncertainty, lack of conviction, and you're seeing that play through.
So Barbara Ann, is this a matter of the equity markets just finally catching up with the bond markets and saying, oh, you know what, we are going to tighten?
I think so. You know, in our industry, there's the whole mantra, don't fight the Fed. And I don't think you should here. They've been very clear that the narrative is no longer transitory, that they are going to front load hikes. And that's what the market is finally pricing in. And, you know, it's very interesting because while Jerome Powell can crush the cyclical parts of the economy that he can control, I worry about what's he going to do about the sources of inflation that he can't control.
Well, that's a really good question. For example, supply chain, right, Barbara Ann?
Correct. Absolutely. And, you know, there is no interest rate that can solve the inflationary effects of deglobalization. And effectively, over the last 3 decades, we've had minimal geopolitical risk, and that's encouraged managements to outsource and offshore, and that was great for margins and shareholder returns. But just in time has become just in case now that we have a pandemic and a war, and those efficient supply chains are now coming across as very vulnerable and fragile in the face of exogenous shocks. And so I fear that there is no rate of interest rate that can fix that, and there is no quick fix to that, which is why I believe inflation will be here for longer than the market is anticipating.
So, Rick, what should the realistic target for the Fed be at this point? I mean, you always talked about 2%. We're way past 2%. I don't think we're going to get back there anytime soon. What's a realistic target?
So, you know, it's a question of how much the Fed feels like they need to get into tightening, as Chair Powell has described. The thing that is ironic about this period of tightening is you're starting to see cracks in the system in terms of the economy starting to moderate in a pretty significant way. You're seeing that in some of the consumption data. You're seeing that in some of the corporate data. And so it's a tricky time. I mean, listen, I think the Fed is going to overshoot and try and bring down inflation. I think what Barbara said is right. You've got, you know, when you talk about the shocked effect on food from the Ukrainian dynamic, when you talk about the shocked effect that's also had on energy, we talk about supply chain, you talk about China locked down now and creating an exacerbation of the supply chain issues. These are tricky things for the Fed to deal with, by the way, without hurting employment. You know, what you want to keep doing is keep closing the income gap, keep people working, start bringing more people in the workforce. There are not enough people in the workforce today. So it's a very delicate balance. I think the Fed, as the chair said, I think they need to move expeditiously. And it's part of why I think you're going to get a 50 base point hike, I believe, in May. And you could get, well, probably 50 base point hikes in the subsequent 2 meetings. They could go a bit more than that. And if you move quicker and then take a look and see how the economy is developing, I think is the prescribed path from here.
Barbara, I think in my contract, I'm required now to ask about hard and soft landings. I think that's the required question to ask now. What about that? I mean, we have Chair Yellen, Treasury Secretary Yellen actually telling us this week she hopes with some luck that they can actually have a soft landing. We heard Chair Powell say he's really shooting for a soft landing. What are the chances?
I don't see it. It's really tricky. There's so many things that are unprecedented about this time. Typically, you would be rising rates into an accelerating growth. And here, inflation isn't just a problem in the US, it's global. So everywhere governments are trying to raise rates. And so that's particularly tricky. The other thing is, I think you have to differentiate between asset inflation and price inflation. When you have asset inflation, that's celebrated as a boom. Stocks and houses and real estate, they all go up. Great. Price inflation affects affordability. And that's what we're seeing now. It's food and energy. So rates might bring down asset inflation. It might bring down the multiple in the market to a more normalized 15%, but 15 times. But what do you do about price inflation when it's driven by a permanently altered supply chain? So This is super, super tricky. On top of that, you are now lapping this month, actually, the last stimulus check. So I see this as a bit of a Wile E. Coyote moment for the consumer, where they're faced with higher inflation. The average basket today costs $5,200 more than it did last year for this time for the consumer, plus higher inflation and higher, and higher interest rates. So this is very tricky. I'm very happy that unemployment rates are so low, but the reality is real wage growth is not rising; it's falling.
So, Rick, you manage, last time I checked, a fair amount of money for BlackRock over there. Give us some investment advice. You manage both fixed income and equities. The yields have really gone up on bonds. Is it getting to be time to buy bonds? I know you brought a chart. We'll show it for our TV audience. You can describe it, about the yields between dividend companies as opposed to fixed income.
Yeah, I mean, actually, if you could pull that up, I'll show you. So this is pretty remarkable dynamic. I always feel like there's this extraordinary focus in the equity market about what earnings are going to do. But really, how you think about, how I think about equities, it's really your cash flow relative to your cost to finance it. And you think about what that means. What people have been doing the last few years is, gosh, I get no yield on my fixed income. I got to go to equities. Look at that chart and look at particularly the yellow line shooting higher. Fed raises rates. You can buy investment grade credit at dramatically cheaper prices, 300 basis points cheaper prices. And then the differential between dividends and what you can get on investment grade credit collapses, meaning there's an alternative. Gosh, I don't have to own equities for my income. I don't need to own dividends. I can actually get it in more, quite frankly, more liquid form. I can get it in higher quality form. And so I think this is part of why the delayed reaction function of the equity market was so extraordinary. Is like they weren't getting this chart for a while. So what do you do with that? Listen, I think you got to be a bit careful about equities here for a period of time. This trade-off last couple of days is starting to bring some interesting levels. I still believe you have to be a bit cautious on equities. I think by the end of the year, equities will trade higher, but I think you have to be cautious today. And one of the things we're doing now is we're holding a lot of cash, and when financial conditions tighten, we think that is a useful utility. And then we're starting to wade our way into some of this investment grade credit, some of these municipal bonds that all of a sudden are getting you 4%. You go out the curve and you're getting 5% or a bit more than that. Those are pretty attractive, particularly if you think the economy's slowing. You're talking about the top part of the capital stack, and pretty good yields. So anyway, we're starting to wade in, but the primary objective today is be conservative until we start to see the Fed, which I think at the May meeting, you're going to start to lay out more of the plan of how much you're going to go on rate, how much you're going to move the balance sheet, which is, I would argue, a bigger impact if you drain liquidity from the system. So, patience is at the top of my investment pyramid today.